Good afternoon, everyone, and welcome back to the Impacting Policy series, um, brought to you by the Impact Program and the Institute for Health Policy Studies here at UCSF. My name is Janet Kaufman. I am one of the two co-associate directors of IHPS for policy programs, and it's my pleasure to first introduce this series for this fall to you and then give our lecture today. Just want to ask you all to send positive thoughts to my colleague and partner in this work, Dr. Beth Griffiths, who is unfortunately dealing with a family emergency today. So let me get started and pull up our slide deck. And I should say, as you have questions, please put them in the Q&A forum. Since this is a webinar, we're not using chat, but do use the Q&A forum for questions. We'll kind of go through the presentation and then take questions afterwards. So this is a series this fall on health insurance, and our learning objectives are first to define some key terms related to health insurance. Some of you may be quite conversant in this, but we thought just a little bit of review is good for level setting. We're going to also then, let me see if I can get this to work. It was working earlier. Understand eligibility and benefits associated with the most common types of health insurance in the U.S., and then outline the key policies regarding health insurance, as well as how those policies have changed over time and their impact on the public. So it's a three-part series. We're kicking it off today with private insurance. In October, which will be the same time, second Wednesday at 12, we're going to dive into Medicare. And then in November, we're going to discuss Medicaid, which we know as Medi-Cal in California, because, hey, in California, we like to give programs our own special names. So this is a three-parter, because I think each of these topics warrant at least an hour webinar, if not more. And just another slide here to kind of level set all of us. So this is the U.S. population in 2022 by type of health insurance. And we'll see the largest chunk of Americans, 48.7%, have health insurance through their employer. And so that's private insurance that is provided by their employer. And folks typically pay a share of the cost, but not the full cost themselves. Then at 6.3% is non-group coverage. So that's coverage that people purchase for themselves and their families, either through a marketplace like Covered California or individual separately. The next most common form of health insurance is Medicaid, which is for lower income people, followed by Medicare, which is for seniors regardless of income. And according to these data from 2022 American Community Survey, 8% of the U.S. population was uninsured that year. And as we'll talk about later, the Affordable Care Act has really contributed to driving down the rate of uninsurance. A couple key differences between the U.S. overall and California. California, we have a higher proportion of the population on Medicaid and a lower proportion that's uninsured. And as we go through this series, we'll be talking about some policy choices that California has made that help explain those differences. And so, let's see. I just realized, excuse me, folks, I think something that we meant to put in here is missing about terminology. So maybe we'll just go over terminology, quickly as we go here. And I apologize, this has been a little this morning. But I think in terms of some of the key terminology, and I'll channel some of what I talk of with my students, is understanding I think the difference between premiums and cost sharing for health insurance. So premium is what you pay each month, whether you use your insurance or not. So if you're a UCSF employee, you look at your pay stub, there's going to be a line there that's that indicates the type of health insurance you've chose within UCSF and how much is being taken out to cover yourself. And perhaps your partner or your children, should you choose family coverage. So that's the premium, kind of like, for your auto or home insurance or renter's insurance. You pay it every month, whether you use it or not. Cost sharing refers to what you pay when you actually use healthcare services. When you go to the doctor, your doctor's office, you go to the ED, you're admitted to the hospital. And there's, sort of three main buckets of that. The first is deductible, and deductible is the amount you pay before your insurance kicks in. So you can think of this if you've ever, as I have had the misfortune, to be in a few car accidents. The deductible is that amount that you've got to pay before the insurance covers anything. Co-payments and co-insurance are your share of cost when the insurer is covering some of the cost. So co-payment is a flat dollar. So a good example for those of you who are in Kaiser, the Kaiser UCSF plan, $20 copay for an office visit. Doesn't matter what the doctor does during that visit, $20. Your prescription drugs, $5 for generic. I think it's 20 for brand name. So that's a co-payment. Co-insurance is a percentage. And so some of our other plans for certain services, you pay a percentage of the total. So that might be 20%, 30%. And then the amount, because it's a percentage, the amount varies depending on the charge for the service. So needless to say, co-insurance can be a little harder to keep track of. So with that little bit of terminology, let's dive in to our discussion of private health insurance. In our learning objectives here, we talked about terms. We're really going to focus here in this section on key policies of the Affordable Care Act with respect to private insurance and how these policies have changed over time and their impact. And then we'll also talk about some of the advantages and disadvantages of employer-sponsored insurance. I mean, for ill or for good, as you saw on the slide, employer-sponsored insurance is the most common form of health insurance in the United States. It's quite different from some other developed countries. And so we'll talk about the pluses and minuses of that. And we'll try to leave plenty of time for questions at the end. So first, the Affordable Care Act and private insurance. And a reminder, this is the Affordable Care Act was enacted 14 years ago. And it was not an easy road to get to the Affordable Care Act. Some of us are old enough to remember the Clinton Healthcare Reform Act, which was, I think, was introduced in 93 and went down in flames in 94. We've also, ever since it was enacted, faced threats to defund it, to stop it. It was labeled Obamacare after President Obama, who signed it. And I think, depending on your feelings, that was either a badge of honor or an element of derision. As you see with these two competing, photos here. The Affordable Care Act had 10 titles. It's a really complex piece of legislation. And you can see here, I'm not going to read all of these. I think we're going to today focus a lot on affordable and available coverage. When we discuss Medicaid in November, we'll talk a lot about the section of the ACA that has to do with Medicaid and CHIP, the Children's Health Insurance Program. In October, when we talk about Medicare, we'll talk somewhat about the delivery system reforms and their implications. But there's, a lot here in the Affordable Care Act. So what are some of the key three pillars? And I got to give Dr. Griffiths credit for putting the slide together, because I think it does help you all think of the three kind of pillars of the ways in which the Affordable Care Act changed insurance markets, particularly the individual insurance markets. Ban on pre-existing conditions, individual mandate, and subsidies. And we'll talk about each of these as we go forward. So first, to talk a little bit about the exchanges, and you all have probably all heard of Covered California. That's our health insurance exchange here in California. And you might say, well, what is an exchange? I think a lot of people have that questions initially. And so I think the way to think about it is it's an online marketplace for folks who need to buy individual coverage or small group coverage, people who aren't getting the coverage through their employer or are running a small business and want to go through an exchange. Um, and so it's really an shopping marketplace, and you've all used these. You've looked at things like Google flights. You've looked at Expedia, tells you name it. You've looked at them all. But this is sort of marketplace for health insurance, and a marketplace that's standardized in important ways, in the sense that it provides a standardized way to compare various health insurance options. And oops. And does that by having 4 standardized benefit designs and having a set of 10 sets of essential health benefits that all plans that can cover. So it's a way to make comparisons, and it's also the vehicle for getting subsidies for coverage if you qualify. And the exchange also requires guaranteed issue and renewability, and allows rating based only on age, geography, family composition, and tobacco use. So what does that mean? Well, guaranteed issue means you cannot be turned down for any reason. For those of you that still remember those old Ed McMahon Publishers Clearinghouse, no reason. You cannot be denied. And you're also guaranteed renewability. So it's not as and this is really important, because back before the ACA, the individual insurance market in many was a bit of the Wild West, particularly here in California. So you could be turned down because you had pre-existing conditions, because you had diabetes, because you had asthma, because you were a cancer survivor. And your coverage might not have been renewed if, like, oh, oops, you have a new cancer diagnosis. Well, nope, no more room for you in the plan. And so these are really, really important protections for people in the individual insurance market. These things really didn't happen so much in the employer market because of both laws and sort of custom in how employer insurance is done. And it says, well, you can change, you also, what the ACA says is you can't rate based on people's individual health status. We can't say, well, because you're someone with multiple chronic conditions, we're going to charge you more than somebody who doesn't have any chronic conditions. We said, well, we're going to base it on some other things. We'll base it on age. And the theory there, well, older folks do tend to use more health services. Base it on geography. As we all know, some things cost more in San Francisco than they cost in Fresno. And many things cost more in San Francisco and Fresno than they do in Mississippi. Family composition. Well, if you're only one person, that's less costly to cover than, let's say, if you're a family of 4. Tobacco use is really the only health factor on which insurance rates could be set. But here in California, we disallow that. And then the exchanges pool risk across individuals. And this is a really, really important concept. In employer insurance, the rates are set based on everybody. So if we think about the University of California system and the health plans that bid to provide coverage to University of California employees, they're setting rates based on, the expected expenses, the risks, if you will, across everybody at UC enrolled in those plans. So everybody from really healthy people right out of college to, people who are, in their 60s and, battling multiple chronic conditions. And so it's a whole, it's a whole range, people who have disabilities that necessitate using a lot of health insurance to people who a lot of health services, to people who don't. And so it's pooled across all these thousands of people. Well, prior to the ACA, in the individual market, you were rated on yourself or your family. And what the exchanges do is mimic that employer in pooling the risk across enrollees so that the rates really, reflect sort of the average across the healthier and the sicker people. and this is really important, and it's as you know, Dr. Griffiths notes here on the slide deck, it's important linked to the individual mandate, but the subsidies also help regardless, as we'll discuss in a minute. And this also, the ACA requires health plans to justify rate increases to really make a compelling case as to why rates should be increased. I mentioned the essential health benefits earlier. If you look to the right of the slide, you can see a list of them. They're intentionally broad categories of services. And what this does too, that I think I should say, this again for the exchanges ensures that people can make apples to apples comparisons and ensures that the health insurance people do have covers, the most, a wide range of services that people might possibly need. There are also some limits on cost sharing for preventive services. Recommended preventive services are available without copay or co-insurance. So if, for example, you're a person of the age group for which colon cancer screening is recommended, you don't have to pay to get that screening test. Your health insurance will cover the full cost. And yes, and all the plans have to require at least these essential health benefits. They can't offer more. Benefit design, I mentioned. And so 4 standardized designs: bronze, silver, gold, platinum. You may have heard of these metal tiers and wondered, what is that about? Well, what it's about is the average share, the share, I should say, is the percentage of the average overall cost of healthcare services that the health plan will pay for versus you will pay for. And so it ranges from 60% at bronze to 90% at platinum. And so if you can think about that, the premiums are going to go from on the low side for bronze to the high side for platinum. Why? Because if the health plan is paying 60% of average cost, its cost is going to be lower than if they're paying 90% of average cost. So, premiums lower for bronze, higher for platinum. Cost sharing, the reverse. If you have a bronze plan, your cost sharing when you get services is going to be substantially higher than for somebody in a platinum plan, because the person in the platinum plan has been paying this higher premium, and the health plan doesn't feel the same need to charge as much when you get care. And so what this means for people is you need to think, if you're getting a plan through the exchange, is what's my tolerance for risk, as we say, as we might say in a jargony way or less jargony, what do I know about the amount of services I think I'm going to use? If I think I'm going to use a lot of services, then I might be ahead to buy a platinum plan with a higher premium. If I think I'm a lot healthier than average, then maybe it makes sense to get a bronze plan with a lower premium and, hope and pray that I don't have a really serious illness where I might be stuck with a big amount of cost sharing. Also, the ACA reduces the out-of-pocket limits for people with incomes up to 400% of poverty, meaning the amount that you actually pay. So everyone who, I should say, the exchanges have opportunities for premium subsidies and cost sharing subsidies. And what this refers to here is the cost sharing subsidies, which are really intended to help folks with lower to more moderate incomes pay for services when they really need them. So subsidies, they are limited to U.S. citizens and legal immigrants. In California, we do have some provisions around Medicaid that are specific to undocumented immigrants, but at the national level, everything is limited to U.S. citizens and legal immigrants, and I think that's unlikely to change. It's generally for people who don't get their insurance through their employer, but there is an exception for people who are offered coverage by an employer, but are not, okay, I should say people who are not, let me read this. Employees who are offered coverage by an employer are not eligible for premium subsidies unless the employer plan is unaffordable, which is defined as 9.5% more of income. So if your employer offers coverage where the cost is, 9.5% of income or less, you can't get a subsidy for coverage through the exchange. I mean, you could theoretically buy it, but you won't get the subsidy. But if your coverage is unaffordable, the exchange is an alternative to you, and it can be a good alternative for people in low-wage jobs. The premium subsidies are on a sliding scale. So the lower your income, the more you pay. I should say in California, the floor is not 100%, it's 138%, and that's because we opted to expand the Medicaid program. And they are pegged to the cost of the second lowest silver plan. Mentioned cost sharing subsidies before. We'll talk a little bit here about the individual mandate, which was included in the ACA at the time it was enacted. And at the time the ACA was enacted, this individual mandate provision required U.S. citizens and legal residents to have qualifying coverage to purchase health insurance or pay a tax penalty. And the penalty approximately $700 per year per individual, or $2,000 per family. So a financial incentive to purchase coverage to get people into the exchanges to help with the risk pooling, and also to encourage people who qualify for Medicaid to sign up for that. There are some important exemptions. Undocumented immigrants I mentioned, also financial hardship, religious objection, folks have religious objections, allows folks to have, temporary gaps in coverage of less than 3 months. But the idea was to really nudge people, as many people as possible, to buy health insurance so that both the healthier and sicker people were purchasing coverage, and we'd be spreading the risk further. And the ACA required employers with 50 or more employees to provide insurance or pay a penalty. So other reforms, and one that I think is of great importance to our students here at UCSF, concerns the magic number 26. The ACA allows dependents to stay on their parents' coverage up to age 26. So if you are younger and your parents have insurance, either they purchase individually or through their employer, there's an option for you to stay on that insurance instead of getting your own coverage. Another thing that's important is medical loss ratios. So that means, that medical loss ratio has to do with the percentage of revenue that health plans spend on medical care and quality improvement. And so the ACA says that health plans have to spend at least 80 to 85% of their revenue on care and quality improvement. So that's intended to really ensure that the bulk of spending, of revenue is really spent on things that will improve the health and well-being of people. Limits to deductibles in the small group market to try to make coverage more affordable, and prohibiting individual and group plans from placing lifetime or annual limits on the dollar value of coverage. So meaning prohibits you from saying, well, there's a maximum amount of coverage you can get this year, and if you go over it, oops, too bad. Note that that's quite different from our dental plan here at UCSF, but nonetheless, so there isn't an annual limit, and there's not a lifetime limit. And so this is really important for people who have expensive condition. People say fighting, cancer, for which there's a need for expensive treatment. People with conditions like multiple sclerosis, for example, multiple chronic debilitating conditions. Also prohibits insurers from rescinding coverage, except in cases of fraud. So ensure, if you're someone who's had, catastrophic accident, you've had a catastrophic cancer diagnosis, your insurer can't, look back at the end of the year and say, okay, we're going to pull your policy because, man, you cost us a lot of money. Nope, we're not going to do that, because what health insurance really, I think the philosophy of the folks of the ACA is, health insurance really should be there for you, especially when you're sick. So now I'm going to pause a little bit and then we'll turn to challenges to and expansions of the ACA. And so Trump era challenges, if we can wind back the clock to the period from 2017 to 2020, the immediate pre-pandemic years. So there was congressional action to repeal the tax penalty for the individual mandate. So technically the individual mandate is still on the books, but there's no penalty associated with it. There were also administrative actions that the Trump administration took. So they broadened the availability of quote unquote short-term plans that don't cover all essential health benefits or cover pre-existing conditions. And the argument was, well, we should make coverage more affordable for people. And these short-term plans indeed cost less, but they're not comprehensive. And especially for people for their pre-existing conditions, they may not cover those conditions. So it's one of the things where, yes, they're lower cost, but buyer beware. The cut premium tax credits, removed cost sharing assistance, and made enrollment plans more difficult by doing things like cutting advertising and consumer assistance, shortening open enrollment, ending automatic re-enrollment. That didn't play out quite the same way in California. I mean, we've really been bullish on Covered California and have spent a lot of state money to advertise it. And, this time of year is we're in open enrollment. If anything, I think sometimes some of us get a little tired of the Covered California ads, but it's important because what it's doing is really reminding people that it's here and available for them. Public charge, we'll talk a little more about this when we get into Medicaid, but that's, essentially, I would say what's the impact of that is scaring people who are legal immigrants into not applying for coverage they'd otherwise be entitled to. And then court actions. The Trump administration declined to defend the ACA in a very important case called Texas versus US, in which the plaintiffs asserted that the entire ACA is unconstitutional after the tax penalties for not having insurance were removed. In that case, the Supreme Court basically said, no, the fact that one, these penalties have been removed doesn't invalidate the whole ACA. And then pandemic hits us, 2020 election, President Biden is elected. And President Biden embarks upon some important expansions of the ACA, sort of incrementally building on the foundation laid during the Obama administration. And so key congressional actions were to expand premium tax credits for 2021 and 22. And that's made them more generous for everybody, and for the first time offered tax credits for people with incomes beyond 400% of the federal poverty level to make insurance more affordable for those folks who, while their incomes are, maybe high relative to the average in the country, when you're in a high cost place like the Bay Area, are still folks who can struggle to pay for health insurance. So the American Rescue Plan Act expanded these credits, and they were made permanent by the Inflation permanent by the Inflation Reduction Act, although I believe they expire in 2025. So administrative actions, they opened a special enrollment period, February to May 2021, with increased advertising to get folks to sign up, withdrew approval for state waivers that would have imposed work requirements on Medicaid coverage. We'll talk more about that in November. And court actions defended the ACA in Texas versus the United States. Really not surprisingly, I think President Biden being President Obama's vice president, that he decided to pick that up and defend that. And so really, we have the highest levels, I think, of enrollment, certainly in the exchanges that we've ever had, in part due to these actions. California really has been a staunch defender of the ACA and has expanded and built upon the ACA incrementally. We outlawed short-term plans. We said, no, folks are going to, that we want to be sure that everybody has comprehensive coverage. We're not going to do these short-term plans that aren't comprehensive. We covered California has negotiated its own design and fees directly with health insurance carriers so that our marketplace is even more standardized than the federal marketplace and the marketplaces in some states. We, I think can thank Peter Lee, who was the founding director of Covered California, for his leadership in that area, along with Governor Newsom and Javier Becerra, who you see pictured here. We've, as I mentioned, been aggressive in promoting and marketing Covered California. We also in California reinstated the individual penalty for not purchasing insurance, the same level as the prior federal penalty. So while in most parts of the country, you no longer have to pay a penalty if you don't have health insurance, here in California, you do. I mean, again, some reasonable exceptions, but the vast majority of folks, those who are legal immigrants or citizens, have to pay a penalty. We expanded premium subsidies to people up to 600% of poverty and more generous subsidies for 100% to 400%. We were out in front of that before that happened at the national level. We led the defense of the ACA in Texas versus US, and we're expanded Medicaid coverage to undocumented immigrants. And starting this year, all undocumented immigrants who meet the income requirements for Medicaid can sign up for it. So moving on to talk a little bit about access to care and impacts of the ACA. This chart from the Gallup Health and Wellbeing Index, looks at the percentage of adults without health insurance since 2008 to 2018. Data are a little old, but I think what they really show, if you look at that period from 2012 to say 2015, that's where you see this real sharp drop in the number of Americans who are uninsured. And that's when the Medicaid expansion, individual mandate takes effect, Medicaid expansion, exchanges go live. So that's, I think, really compelling evidence that the ACA helped to drive down the number of Americans who are uninsured, and it's been further driven down since then. This just, compares California to the United States. And then this last graph here looks at coverage gain, who gained coverage by income, age, race, ethnicity, urban, rural, versus and self-reported health status. So you see some of the largest gains among lower income people, among adults 18 to 34, the group that historically has had the least access to employer provided insurance. Biggest gains for Latins, followed by Blacks. And, I think some of the biggest gains also for people whose health status was, was fair to poor, or at least not excellent or very good. Also saw some growth in, some slowing in spending growth. Some changes in premium increases. ACA premiums fell in many areas in 2020, but with a lot of variation. So, and I think we really can conclude that the ACA has had a substantial impact on reducing the number of people who are uninsured, somewhat, large in part through Medicaid expansion, and in part through the exchanges and the changes in the rules governing private insurance markets. And it really is the biggest single piece of healthcare legislation in the United States since Medicare and Medicaid were enacted in 1965. So I'm going to turn now to talk a bit about employer-sponsored insurance before we go to questions. And so long tradition of employer-sponsored insurance in the US dating back to World War II. And one of the earliest forms of employer-sponsored insurance was the precursor to what we know today as Kaiser Permanente, which started as coverage for people working in the Kaiser shipyards, which played a major role in production of ships for the Navy in World War II. It's important to know that employer-sponsored insurance is heavily subsidized by the federal government because it's not taxed. You and I, that if you look at your pay stub, you look at sort of what's taken out pre-tax, post-tax, your health insurance is not taxed. It's pre-tax. You don't pay a tax on it. Employer doesn't pay a tax on it. So in that, it's less, it's less obvious than what we spend on, say, Medicare and Medicaid, but it is heavily subsidized. Um, Also important to note that over, time, the proportion of workers who are eligible for employer-sponsored coverage has dropped somewhat. This is looking at 99 to 2014. And also really important to know that part-time workers are much less likely to be offered employer-sponsored health insurance. And so this, really is a challenge for those folks who either need to work part-time because of their circumstances or just can't find full-time work and are kind of cobbling together several part-time jobs. This, kind of gives you an estimate of the cost of the the exclusion from taxes of employer paid premiums for health insurance. So I should say you're not taxed and your employer is not taxed. So 250 billion, that's quite a lot. And these 2017 estimates show you that that's much bigger than the cost associated with the Medicaid expansion, the Obamacare subsidies. Now, number of folks enrolled in Medicaid expansion, number of folks in program changes has grown, but it's still nowhere near the costs associated with the tax exclusion for employer paid premiums. One of the things I want to talk, I mentioned deductibles earlier. One of the challenges that we see with employer-sponsored insurance is high deductible plans. And so this is a slide that shows the deductibles that adults with employer-sponsored health insurance pay. 15% no deductible. That's really, really generous coverage. But 21%, 1 out of 5, the deductible is over $3,000 for an individual and over $5,000 for a family. And now some of us on the faculty earn pretty good incomes, and we probably have enough money saved up that we could cope with those deductibles. But many folks working here at UCSF and working in San Francisco around the country live paycheck to paycheck and just don't have enough money in the bank to cover those really high deductibles. And not surprisingly, some of the highest deductibles are charged for folks who are lower wage workers and have less ability to bargain with their employers for health insurance benefits. And what are some of the consequences of that people with employer coverage report difficult, what are some of the difficulties that they encounter if they don't have robust coverage to their employer or feel they can't afford it? Well, they have problems paying their bills, especially paying their bills before the deductible. Really, I think the ACA, it's done a lot of good, but I do think this is sort of some of the unfinished business is the affordability of employer-sponsored insurance for folks in lower wage jobs. And just this last one showing that half of people with employer-sponsored insurance say someone in the family skipped or postponed needed care or a prescription because of cost. So, taking over-the-counter drugs or home remedies instead of seeing the doctor or putting off getting therapy. So just, evidence of why this is a problem that needs attention. Key point here is that, while we talk about private insurance and public insurance, and public meaning Medicare and Medicaid, we kind of sometimes talk about them in separate buckets. reality is that they're intertwined. There is private insurance in Medi-Cal and Medicare. And the way that works is that the Medicaid program, Medi-Cal, Medicaid programs at the state level and the federal Medicare program contract with private health plans. And so you may have heard of something called Medicare Advantage. So Medicare Advantage are private insurance plans in which Medicare beneficiaries can enroll. So that could be Kaiser, could be Anthem Blue Cross, could be Health, all sorts of various carriers that have Medicare Advantage products. And the proportion of Medicare beneficiaries who are in Medicare Advantage plans has skyrocketed. This shows 2008 to 2022 from 19% in a Medicare Advantage plan in 2007 to 50% in 2023. So half of our Medicare beneficiaries are in these private plans. And 70% of Medicaid patients nationwide are in some form of managed care. And here in California, I think it's considerably north of 70%. This last slide here just shows Medicaid managed care penetration across the country. And you can see here in California, I guess we're in the middle bucket here. But that was from 2018. I think that's changed a little bit. But really, really important to understand that and talk about the key role of private managed care plans in both Medicare and Medicaid. So some key take-home points: ACA significantly altered private health insurance markets, particularly for people not working for large employers. The individual mandate, the ban on pre-existing conditions and subsidies were designed to work together in tandem. Interestingly, I think there was a lot of concern back when the federal, the tax penalty associated with the federal individual mandate was repealed, that we were going to see just a big decline in take-up of health insurance. We saw some, but not nearly as big of a drop as some economists initially predicted. I don't know that we know exactly why, but I think there's a sense that, people came to really value health insurance and saw the value of paying for it, even when they didn't absolutely have to do it. Or I should say, didn't have to face a tax penalty for not doing it. The policy decisions about the ACA have had significant impact on how many people have health insurance and what it costs them. Key role of employer-sponsored insurance, which is heavily subsidized and I would say less regulated overall than Medicaid and Medicare, although there's quite a bit of variance in regulation across states. And here in California with our Department of Managed Healthcare, I'd say we're kind of on the more regulated side, at least for those plans that states are authorized to regulate. And mentioned private insurance role in Medicare and Medicaid. So with that, I'm going to stop sharing the slide deck, and I think that leaves us about 15 minutes for dialogue. And so please put any questions you have in the chat. It looks like there's one. Does this apply to ERISA regulations on employer-sponsored insurance at all? That is a great question. I mean, the first answer is, what is ERISA? Well, ERISA is a piece of legislation passed in the early 70s. It's Employee Retirement Income Security Act. But what that does is that has allowed large employers to self-insure. And what do I mean by that? Well, the sort of conventional, traditional part of insurance is whether you're an individual or an employer, you're buying coverage directly from the insurance plan. And they're setting the premium, and they're going to absorb any risk associated with underestimating premiums, meaning any risk associated with charging less than it's really going to cost them. So when we go, say those of us who enroll in Kaiser, that's that sort of traditional fully insured product. And there are other, not just Kaiser, but others that are fully insured like that. Self-insured means that the employer may often contract with a private plan to administer the benefits, administer the provider network, but the employer themselves is absorbing the risk if the premium, if costs exceed premiums. And a large employer, can do that because as think of the University of California, think of Wells Fargo, think of some other big employer, they have enough assets that they can cover any potential cost overruns in a way that would be very impossible, very difficult for a small business, particularly a small business on a tight margin, something like, say, a restaurant. And so getting back to the question, so that's what a risk is. And the question is, so does this apply? So, a lot of the provisions that the ACA does require employers 50 or more to provide some sort of insurance, either either to purchase it or self-insure. There's already, prior to the ACA legislation kind of governing things like pre-existing conditions for employer-sponsored insurance, but a lot of the ACA is more targeted at the individual market. Other questions people have? I realize this is kind of like a lot to throw out there. I think one thing maybe I'll add here, given that we just had a presidential debate last night while you're thinking about your questions, and is to say, well, what might happen in November? And I think it's fair to say if Vice President Harris were elected, you'll see, I think, a continuation of the Biden administration's incremental approach to building on the ACA. I believe that she, like President Biden, feels that as like a really, key important accomplishment of the Obama administration and of the Democratic Party. If you, on the Trump side, I certainly don't think he's going to work to incrementally improve on the ACA. Is he going to offer something different? I think the answer is we just don't know. I do think what you are probably going to see is certainly he's going to be under a lot of political pressure to erode access to reproductive health services and coverage for those services. Any other, questions, comments? I think give it maybe one more minute, and if we don't have any other further questions, I think we'll adjourn. The slides will be available, and really welcome your feedback. This is our first kind of series where we're really focusing on content and health policy rather than skill building, and really want your feedback of like, was this too basic, too far in the weeds? And also really invite you all to join us for the October webinar on Medicare and the November webinar on Medicaid. And thanks, everybody.